Good morning and a very warm welcome to this presentation by Magle Chemoswed in connection with the report for second quarter of 2021. The company will today be represented by CEO Justin Pierce and by CFO Petra Jönsson Sjölin. As for myself, I am Alf Riple. I work at Västra Hamnen Corporate Finance and I will be your moderator for today. We will start with a presentation by the company and after that we will have a Q&A session. So you are also welcome to write your questions. Questions can be written under the heading that says questions, either on the right side of your screen or on the bottom of your screen. It might be marked with a talk bubble also, depending on your device. It remains to be said that this session is being recorded and that the recording can be accessed through Magle Chemoswed's homepage later on or through Västra Hamnen Corporate Finance channel on YouTube. So with that, I would like to give the word to you, Justin and Petra.
Morning, thanks Alf, and thank you for hosting us again. That's very helpful. So looking at the Q2 report, which Petra has control over, we saw a very solid quarter with good performance in the CDMO side of the business that we were very happy with, well within the expectations that we had going into the quarter, and certainly the business performed perfectly in line with expectations of where we wanted to end. COVID, of course, continues to be an influence in some of our target markets. This is especially related to more of our own technology products when it comes to the areas such as the United States and the Asia Pacific, where COVID is still a predominant factor there. So we still have some challenges related to COVID. But other than that, we see that the general CDMO business and the manufacturing business is now starting to return to more, if we can call it, pre-COVID times in relation to that. And of course, as a result of that, this has stabilized much of our manufacturing revenues that we had previously suffered from very late fluctuations and uncertainty in supply chain with some of our customers. We're seeing that that's starting to stabilize back down for ourselves now. And of course, then for us on the technology side, we closed the acquisition of the Pharmacept company in Germany. And we've done all the registrations and all the formalities have been completed in Germany. And now our integration program with that company is now well underway in relation to that. So overall, it was a quarter well within expectations, and it's a quarter that certainly didn't bring any heartache or any concern for us. Could you? From a sort of financial summary perspective, EBITDA came in at 4 million. It was around 6.7 million last year. Operating profit 1.2 in comparison to 3. And net sales in the period, excluding currency fluctuation adjustments, is just a little bit below where we were for the same period last time. Profit after tax, just under 1 million, whereas 2.4 last year. And maybe just to put a little bit of context in relation to Q2 last year in comparison to Q2 this year. Q2 last year, we had a large royalty payment from Becton Dickinson. So we had a large USD payment made into us, and that was part of the boost in relation to the operating profit. You can see the difference in the two periods of 1.2 to 3 million. So this was largely as a result of the royalty adjustments that we had between the two periods. But overall, the sales mix, which Petra will deal with in a little bit, I think demonstrates the underlying strength of the business, that we are able to pick up and still maintain strong revenues that are almost like for like in the periods, using different parts of the business and different revenue streams from the operation in order to make sure that from an operating and sales growth, that we're still seeing growth overall in the CDMO segment and other parts of the business. And I think this is the key financial indicator for us in the underlying strength of the business, not being entirely reliant on the royalty to come in order for the company still to remain profitable and to remain likewise on a sort of even keel when it comes to sales, excluding currency fluctuations for the periods. Petra. So operational highlights, a little bit of repetitiveness in terms of what I've already said, but obviously we're experiencing high demand on the CDMO service side of the business. This has allowed us to increase sales in the period and a make-up for a slowdown in the royalty. The slowdown in the royalty is nothing that concerns us terribly. This is largely a direct impact of the reduced number of surgeries in the United States as a result of COVID, and as a result of that, there is less product being sold, and this is causing a slight bump down in the royalty for us. Overall, we've managed to increase our capacities on the CDMO side, so we've taken in a number of new CDMO projects. These projects have increased our sales and have also contributed to the bottom line. And the projects that we've taken on are all long-term projects, so we haven't taken on any short-term projects just for quick revenues. I mean, these are all projects that have gone through serious consideration. We feel that they bring long-term value into the CDMO side of the business. In relation to our technology and our development pipeline, I mean, this is moving forward very strongly now. We have really started pushing registrations of Smart Gel. We're pushing this into Uruguay, Paraguay, and those filings are underway, and we now have also started filing for that product into Kuwait, and we expect to start doing the first manufacturing of Smart Gel late Q3 into Q4 this year for the first product of that to be come out. So that product is moving well. When it comes to Smart Pan, we're in the final stages of the study that we want to do at Heidelberg, and we started the manufacturing of that material to be available for those studies and then into the market shortly after that. So in relation to that, we're playing catch up with some of the delays that we'd experienced previously as a result of COVID. And certainly when it comes to Smart Gel, that product is now moving very quickly. So we're quite excited about bringing that into those territories. When it comes to the remainder of the pipeline is now being re-accelerated as we start to focus on experiencing some of the synergies from Pharmacept and being able to really shorten our time to market, using the sales force to be able to drive our own products into the market. So a lot of the quarter has also been re-evaluating and refocusing on our pipeline development to see which projects we can move forward as quickly as possible to get them into Pharmacept to increase our portfolio of products that we are able to sell ourselves directly. So overall, it was an exciting quarter for us. I think it's a quarter, like I said, that we're quite satisfied with, and I think it demonstrates the real underlying strength and the synergies between the CDMO and the technology side of the business to allow us to continue generating the operating profits that we need, as well as the cash flow that supports our further development on the technology side. So overall, it's a satisfactory quarter for us. And I'll hand over to Petra to discuss more of the financial side of the business.
All right, thank you very much, Justin. I will just swap pages so that you can see. So looking at the income statement rolling quarter by quarter, here including 8 months from Q1 for 2020 to Q2 2021. Showing the sales and profitabilities for the periods. Looking at our sales is above expectations, as we have discussed, as Justin recently just said, and also despite the COVID pandemic, we have, as we can say, that black numbers, which is moving forward good. We have 2% less than previous year during the same quarter. But adjusted to currency, we have 8% increase. I will come back closer to the product mix in the next slide. The other revenue is following our expectations within media and government contributions and other income, and this is what we have expected for the period. Looking at closer to the gross margin, due to the declining revenue and licenses that Justin just mentioned, we have recovered the losses in other services, which has, of course, a higher impact on the gross margin due to the raw material purchase and direct material related costs. So this has an impact and showing in the report as well. The raw material and the cost of goods is within our expectations due to the shift in revenue mix, which has been forced upon in the change due to declining licenses for that period. The EBITDA for 12% is within our expectation and are closely monitored with the strong cost control and cost reductions. So we are keeping a good eye on it to making sure that we are in line with our expectations. And then, of course, we have the depreciations. These are due to some activated capital expenditures, which are planned and are moving forward in that part. So moving to the next slide, we have here we are presenting the sales mix within the company, and we can see it within the pie charts comparing the 2 quarters. The sales mix table down below is showing the percentage split within the portfolio for the year-to-date numbers. If we look at the table, we can see that we have a decentralized revenue mix across the portfolio, limiting our risks, but also shifting away from license revenue to a growing service revenue that we have. As Justin recently said, that we have our CDMO services with new projects, long-lasting project, and not short terms, which gives us a good stable base to stand on moving forward. We can also see a declining revenue as we see the declining revenue in the licenses from BD due to the pandemic. As we mentioned, across access to hospital, declining patients in our segment due to that they are in the risk group. We have also weakened USD has an impact on the licenses as we're compared to the previous year. So if you look at the average USD from last year, 2020, it's on 9.55 and compared to this year on the 8.41 as US dollars to the Swedish krona. So this is, of course, has an impact on it as well. As we mentioned before, that we have that adjusting currency effect on that part as well. As we said, we managed to cover the licenses loss with the CDMO project, and as you can see, the API revenues as a part of that for the growth of the period. The CDMO services has grown with 25% compared to previous year. The pickup, as we can see in the API manufacturing, has increased due to the customer project has moved into manufacturing as well, which is at a growth of 55% from previous year and 59% from the previous quarter, which is Q1, which has added also, as I mentioned before, in the gross margin, has also added some extra cost in the cost of goods and the raw material purchase. Moving over to the next slide, I'm bringing up the cash and liquidity aspect of the company now. As you can see, due to the acquisition of Pharmacept and the share issue that was shown in the Q1 quarter, this is the payment that's coming in for the share issue. In Q2, we are paying out the payment for Pharmacept, which of course makes a lower available cash. But our cash flow for operation is high, as you can see. It's mainly due to the changes to working capital, but also we have incoming payments and licenses paid from the first quarter balancing out, which is now also showing in the red bar, as you can see. The yellow line is showing the usage of bank overdraft, which has been lower for this quarter due to the high liquidity that we currently have in the company. So moving forward, this is also what we will continue to present, to showing you the cash and the liquidity in the company. Justin, if you have anything else you want to add for the final thoughts, I'll leave it to you.
Sure. No, thank you, Petra. I have nothing major to add other than just to reiterate that we have noticed that there has been some headlines in relation to a drop in profits, but like I said, the expectations of the quarter were delivered on. and we don't necessarily share the same concerns. I think the year is still on target for us to meet where we want it to be, and that would certainly be year-on-year growth is our forecast, and certainly what it is that we're looking at. So overall, we're fairly satisfied with the quarter, and I think, as Petra says, there is an underlying cash strength as well as an underlying operational strength in terms of sales mix. So overall, we're happy with the quarter. So Alf, I guess it's back to you.
Yes, thank you, Justin. Thank you, Petra, for the presentation. I will just repeat to everybody who's listening that you can ask questions. You can write your questions under the headline, in the menu, in the controls to this platform that says questions. It may be marked with a talk bubble. You can write your questions there, and I will read them out, and Justin and Petra will answer. But just to kick it off, I thought we'd maybe start with the acquisition of Pharmacept. It was completed during the quarter, and it's now fully consolidated on a balance sheet, as far as I can see. You noted when you made the announcement of the acquisition that you expected to gain in the area of 1.7 to 2.5 million euros per year in increased revenue from this acquisition, and that you would reap an extra EBIT of between 0.2 and 0.3 million euros per year. Now, first of all, is this still a fair estimate? And second of all, is this an extra revenue and profit that you will get directly from the inclusion, or is it the level that you will gradually grow into?
That's based very much on historic figures, Alf, and part of the business case in terms of what drove the acquisition. Initially, those are full year figures. So obviously taking Pharmacept in for half the year this year, and taking into consideration some COVID impact that we expect in the reduction of sales around Europe, we still expect to have, estimated right now is between 4 and 11 million as a contribution in SEK to the overall company, and then the same level of EBIT in percentage wise as a result of that revenue. So going forward next year, our expectation for the full year would be to return to normal pre-COVID stages, and there we would be aiming at somewhere within the region of the 1.7 million euro mark in terms of revenue to come back into the company, as has been based on the business case for Pharmacept. So there should be an immediate impact of Pharmacept in that we should see in Q3 and leading into Q4 this year.
Okay, and so you expect full effect in Q3, but was there also an effect in Q2? Was there any impact at all in those numbers in terms of revenue or profits?
No, as we were closing the formalities of Q2, because we closed the deal with Pharmacept early June, and the formalities that we had to go through to register the company and have the shares transitioned, bank accounts and all the other things, the revenue and the cost for June will come into the Q3 numbers. So the Q2 report that you have currently doesn't include the impact of Pharmacept.
Okay. So in basic terms, you should see a direct step up in total revenues between the quarters, the second and the third quarter.
Yeah, absolutely.
All right.
And if I may add as well, you have on the balance sheet, you can only see the acquisition. You can't see the liabilities or the assets that we have in Pharmacept as well. So this is not included. So the purchase price allocation is not a part of the Q2 report and will be added into the Q3 report.
Okay, thanks. Now you mentioned that the timetable that you had for commercialization of SmartPan and SmartGel has had to be amended due to COVID-19. So I just want to get more detail on, you touched upon it before, Justin, but just a little bit more detail on what are the remaining steps until you can actually start selling both of these products. And can you pinpoint more exactly when you expect, in what quarter would it be reasonable to expect to see the first sales revenues from each of these?
The first sales revenues for SmartGel we will see in Q4. So we have confirmed orders from our distribution partner in AXO for those materials, and that manufacturing is now planned. For Smart Pan, it'll either be late Q4 or early Q1 22, and that's largely due to the German market and our ability to access Heidelberg University Hospital, who is our main partner there in driving that product through into the first study. So that's when we expect the first revenues to come in for those two.
Okay. And referring back to the discussion about Pharmacept, I know that you intend to use Pharmacept as your distributor for both of these products. And you know, the figure that we talked about before, the annual expected extra return that you get from Pharmacept, I suppose, as you said, those are based on historic figures, so they would not include any impact from Smart Gel, Smart Pan. So, I mean, any expected revenues there will come on top of what we have said before. Is that correct?
Yeah, absolutely. And you know, as you know, the company is not in the habit of making those sort of forward-looking statements in relation to expectation. But yes, the revenues in relation to Pharmacept's revenues generated by the sale of Smart Gel and Smart Pan, this would come on top of the historic numbers that I've already mentioned.
Okay. You also, as you said, Petra, you had some substantial headwinds in terms of foreign exchange rates in the first half of this year compared to the same period last year. They were quite substantial, and you have shown very clearly how that affected your revenues. But I suppose they also may have affected your cost side to some extent, or did it feed directly down to the bottom line? Is there a mitigating effect on costs, perhaps?
Yes, it is. Of course, we have some raw materials that we purchase from out of this region, and therefore there is a currency fluctuation on that as well. It will be reflected on the gross margin, but also on the bottom line in the end.
Okay. And you mentioned the dollar, and you know, you also shown in your segment reporting that I think is roughly 2/3 of your revenues come from outside of Europe. But does that mean that the US dollar is your invoice currency for more than half of your revenues, or is that an incorrect take? Or could you say anything about the division of different currencies on your revenues?
The split of the revenues is linked to the region. So we invoice in USD and euros and Swedish krona, and it's divided into the regions that we actually work in.
But Alf, I mean, removing the royalty, which of course is a USD, so that has an immediate USD effect on us in terms of, you know, to give you a rough idea in split between CDMO services that we invoice out, then I'd say the predominant currency there we've moved to euro because we see a little more stability in the euro than we do in the USD. So a number of our clients, even our Swedish clients, we do invoice out into euro. So that is, from our CDMO side, that is our predominant invoicing currency currently.
And how about the cost side? Is it predominantly euros as well?
No, there we try to use the USD because we have some more benefit in relation to that. So certainly on the manufacturing side, when we're negotiating those contracts for heavy raw materials that we are bringing in from China, Japan, or India, that is predominantly on the USD side. In terms of the saving there is probably somewhere around 18 to 20%, which is also us forcing down the initial price and then having some added butter onto the top of that as a result of the lower currency. But in terms of the overall effect in benefit for us on the lower currency rates, this is probably about, I would say, 15% of the losses that we experience on the output side. So it's nowhere near a zero-sum game in terms of what we lose on the sales to the benefit that we get on the purchases.
No, I see. And still, most of your costs must be in SEK anyway.
We try and keep as much of that in SEK as possible. Yeah.
Yeah. All right. I noted in your CEO comment, Justin, that you said that you intend to increase your investments in sales and marketing. Is it possible to quantify what this may entail in terms of either increased headcount or increased outlays in kroner? And a timeline concerned?
Some small questions there, Alf. In terms of, strategically, of course, we see that our own technology products and pushing them into Pharmacept and increasing the sales force is one of the immediate growth areas that we've identified. And strategically, this is, of course, incredibly important for us. The territories that we are very interested in currently, specifically within Europe, is Germany, Italy, Spain, and France. These are areas that we really want to tie down. In terms of headcount, we're looking to add somewhere between 6 and 11 people into those territories over the sort of next strategic period, so the next 3 to 5 year period, to really increase our, let's call it footprint, direct sales footprint, and also to be able to handle what we have coming out of the pipeline. Then on top of that, we see a big opportunity in South America for a number of the products. So this is another area that we are currently evaluating whether or not we should have our own footprint into that, predominantly in Brazil, Argentina, Uruguay, and Paraguay. And then the US is something that we've anticipated having 2 to 4 people in terms of headcount in boots on the ground, pushing our products in that territory. In terms of overall cost, I would say as an estimated cost, we're currently budgeting in somewhere within the region of 40 to 70 million SEK over that period. And of course, we need to look at the return in relation to those investments.
Okay, but the 40 to 70, that will be an accumulated total, not annual terms.
No. There's a lot of one-off setup. So when we're looking at territories, it's also about how we register the products in those territories. So France, Italy, Spain, these sorts of countries, we'll probably look to have a subsidiary, a Pharmacept subsidiary up there that can own the regulatory registrations in those. So there's some regulatory work for us to do, some initial employment costs to take, and the setup. So it won't be the ongoing annual cost base that we need to cover for that expansion.
Okay. And also, I would like to touch upon your gross margins. We were a little bit surprised to see such a high gross margin for the past quarter, the Q2, and especially since the mix, the product mix, or the revenue mix was so strongly slanted towards manufacturing, which we expected would be the area where you have the lowest gross margins. Now, can this be interpreted as you having shifted to a higher level, a sustainable higher level of gross margins in manufacturing? And also, could you give any sort of a quantified estimate of what's a reasonable range for the gross margin in manufacturing going forward?
That depends very much in relation to what we manufacture in each period. Of course, we have some very high profit margin products, and we have some on the lower end. So the challenge for us is making sure that we get the right mix in relation to that. But as a general rule of thumb, we're looking at anywhere between the sort of 82 to 90%. That's our internal sort of KPI and goal. We've also negotiated significantly with raw material suppliers. So we've had an active program over the last 12 months of really trying to drive down our raw material costs. We've introduced a number of lean principles into manufacturing as well, which we've seen starting to see the benefit come from that. We're also looking at increasing our capacity without increasing our overhead and cost. So we've looked at a number of manufacturing times and how we can overlap those. So I think we're starting to see the benefit from that starting to come through on the manufacturing side. And then we've also taken on a number of new manufacturing contracts with customers where we have a higher gross profit in relation to those products for them. And I'm sure Petra has more to add from the financial side.
Yeah, it's as Jönsson said, it's covering a lot of the topics that you just mentioned. But moving forward and also seeing what we have had, we have a closely monitoring the warehousing. We have a close monitoring on the value of the stock. We are currently doing a month-to-month stress testing on the valuation of the stock as well. So I think all of that control and the cost controls that we have put into to active use now, it's also showing the benefit of it. So moving, as you said, is this a stable trend moving forward with the cost controls and in the routines that we have set up? I think we are now having a stable way of moving forward how to value our stock inventory.
Okay, thanks. I would just remind you one last time that there's question, there's opportunity to ask questions. If you're a fast typer, you can put in one question before we close here. My final question to you is, you mentioned that you see a growing demand for Pharmacept S and also Platisept. Is there any particular geography that's pulling this demand?
Yep. We're seeing a lot of demand into Japan, and we have registrations ongoing under that. When it comes to Pharmacept S, we have started making regulatory filings, which we expect to take anywhere between 6 and 9 months for approval. And there we have large markets in Argentina and Brazil. And to put it into context, the overall market for Pharmacept S in Argentina and Brazil is pretty much equivalent to Germany, Spain, and France in terms of European size. So there we would expect to see, once we're up and running there, somewhere within the region of 1,000 to 1,500 units annually being moved into those territories.
Great. I have no further questions, and I can't see that we have received any from the audience. Maybe you would like Jönsson or Petra to have some closing remarks.
No, I just think with Pharmacept, we're moving into a very exciting stage of the company. We've worked very hard over the last 3 to 4 years to really set up the CDMO and stabilize the CDMO side. And to grow that nicely, and I think we've achieved that. We can see that coming in now. We can certainly see the benefit from that sort of expanded sales mix that we've introduced. And moving forward now, I think we're really excited about looking at what we can do with Pharmacept, pushing our technology products to really take the company to the next level in terms of revenue as well as profitability. So I think we're moving into exciting waters.
And having fun during we're doing it as well.
Lovely. Thanks very much, Jönsson and Petra, for taking time to do this, and thank you to everybody in the audience who took the time to listen. And we hope to see you again in 3 months' time.
Sure. Thanks, Alf.
Thank you.
Bye.